Well, hello everyone out there. My name is Arun and today I'm going to deliver my expertise on this topic, discounted dividend valuation. As we talk about discounted dividend valuation, let's first of all understand why dividends are really important and in the very first place what dividend is. Okay, let me give you a very simple perspective on that. Every company in this world exists to generate some net profit. Out of this net profit, some part in a usual year is normally retained and some part is usually distributed back to the shareholders. Okay, the component of net profit which is usually distributed is known as dividends. And shareholders that I'm talking about are common equity shareholders. So dividend is basically the distributed component out of net profit. Well, why do you distribute dividends? Because you want to reward the shareholders, common equity shareholders, for their risk taking, supporting the business by providing the capital. So the way I look at it, any common equity shareholder would be making returns in form of price appreciation as well as dividends over the long run. Okay, let's talk about the other component, which is the retained component of net profit. The question is, why do companies retain net profit? They retain net profit to fund future expansion, because retained net earnings are the cheapest source of capital for a company. So they would like to retain that future expansion. Alright, so now the chapter is all about valuations based on dividends. Why do we base our valuation upon dividends? It's for a very simple reason. Dividend is a benefit for a retail investors. It's a benefit for the common equity shareholder. Company would declare dividend only if it's in a sound financial health, the way I look at it. That's a long-term story, although there could be exceptions to that as well. But normally speaking, companies declare dividends when they're in a sound health. So distribution of dividend, let me repeat, is a signal of sound financial health of an organization. So let's get back to the topic now and start with the valuation process. Okay, so as I talk about valuation, let me say there are two usual ways of valuing up any security, which includes a valuation based on discounted cash flow, although there could be other forms of valuation as well, but I'm going to talk about the two most basic forms of valuation procedures. One is discounted cash flow based valuation and the other is multiple based valuation approach. Okay, so in this approach of discounted dividend valuation is on the basis of discounted cash flow analysis. Okay, as we talk about discounted cash flow analysis, there are three sub-components of DCF based valuation. First, which is based on dividends. Second, which is based on free cash flow. And third, which is based on residual income. There are separate chapters in your curriculum which are based on free cash flow or residual income. So I'll not talk about them in details, but yes, we're going to talk about dividends in a lot of details. Well, let me first explain to you what is free cash flow and residual income so that you do not have any unanswered questions in your mind. Okay, so free cash flow is that cash flow which is generated during a year and after having taken care of some basic obligations like operating expenditures in cash, investments into working capital or investments into fixed capital, whatever remains, all of that is considered as free cash flow. So the way I look at it, dividends are actually distributed to the common equity shareholders, whereas free cash flows are not necessarily distributed, but they are available to be distributed. I hope you notice the difference between the two. Okay, moving on. Free cash flow may have two types to it: free cash flow to the firm or free cash flows that accrue to the equity shareholders. There are valuations could be done on the basis of both of them. We'll talk about these details in the next chapter. Now, what is residual income? Out of these two, residual is comparatively an economic term. Basically, residual income signifies the importance of opportunity cost. Whatever earnings a company is generating during a year, if those earnings are in excess of the opportunity cost, or let's say the justified reward for the common equity shareholders, so that excess component is known as residual income. Let me give you an example. Let's say you invest into my company and my company generates a profit of $12 million. I wish I'm that rich. So if there's a profit of $12 million, and out of those $12 million, so now you think I have given you a profit of $12 million, whereas my company should have generated $10 million to justify your risk taking into my company. That means I'm giving you 2 million excess, in excess to what I should be giving to you. That excess component is known as residual income. Let me say this is excess earnings. But let me say that was put very simply across to you. Once you go through these chapters, you will explore more depth about them. Well, before we move on, let's just simply discuss when should you use dividend discount model, when should you use free cash flow model, or when should you use a residual income model. Although as I already said, I'll not talk in details about two of them. My focus over here is going to be dividends, a model based on dividend valuation. Firstly, you should use dividends for such companies that have a regular dividend paying history. That it's a very funny thing if I say that you can do valuation based on dividend for those companies which are not paying dividends. It'll be very funny to say that. It can't be possible. Well, it can be possible, but then there would be a lot of inaccuracies in that. So the first condition is companies should be paying regular dividends. Then you may use discounted dividend based valuation. Okay, moving on. The next condition when should you use discounted dividend valuation is when you are talking about the minority shareholders perspective. So what do you mean by minority shareholders perspective? Well, the way I look at it, if you are a very rich investor, and I wish you are, as a rich investor, you go on to acquire the majority stake in a company. Tell me, would you be considered? Would you be even bothered whether the company is giving dividends? I don't think so, because you are a majority stakeholder, and you yourself are deciding the dividend levels. You are the decision maker yourself. The way I look at it, dividends are not the right approach to value your stake in the company. So what should you do? In such cases, you tend to use free cash flow based models. So whenever majority perspective comes in, you talk about free cash flow based valuation. Whereas if you talk about the minority perspective, you talk about dividend based valuation models. I hope that is clear. And this is a very important point. I'm putting a star over here, or rather 2 stars. It's a very important point. You need to be aware of it for CF examinations as well. Let's very quickly move on. Okay, the third condition when you start using dividend valuation models is when the dividends are consistent with earnings. Okay, what do I mean by that? Okay, just imagine a situation that earnings of a company remain stagnant over the time, whereas dividends are growing. It might send a misleading signal to the investors that company is doing really well, whereas the company is not doing well because earnings have remained stagnant. Okay, let me take an example for that. Due to shortage of space on the board, I'm gonna rub it off. Okay, let's say earning per share of a company during first, second, and third year remain $10, $10, and $10. Okay, whereas dividends are growing. They were $5, then $6, and then $7. The way I look at it, there's a 40% growth in dividends across 3 years. But the problem over here is dividends are sending misleading signals. Dividends are showing growth, whereas there's no actual growth. In such a case, dividends are not the right way of valuing the company because they're inconsistent with the earnings. Okay, due to lack of space on the board, I'm going to write the 4th point, that when to use dividends over here only. Okay, the last point is when to use dividend. Okay, these are all ideal conditions. When should you use it? When you're talking about a mature company. Okay, Now, what is a mature company in the very first place? Mature company is such a company which has exploited most of the growth opportunities elsewhere. So the growth opportunities for a mature company are all exploited, and whenever it receives a lot of cash, it doesn't know what to do with it, because if it reinvests into its own operations, there are not enough opportunities to justify that. Let me give you an example. You may compare a mature company with a developed economy. In a developed economy, the growth rates are normally less. That's how mature companies also are. They grow at a relatively less pace. On the contrary, there are other set of companies which are known as growth companies. Growth companies are emerging companies. They have a lot of opportunities and projects to invest into. They have high risk and they have a lot of opportunities as well. Okay, so when you talk about growth mature companies, it is better to use discounted dividend models, because mature companies tend to pay a lot of dividends. Whenever they have cash, extra cash, they distribute it. So their dividend payment history is very stable. So you use, okay, so these are the 4 conditions when you start using discounted dividend valuation models. Okay, I'm going to rub it off. I would have asked questions if it was a live session. Nevertheless, we'll move on. Okay, so when should you use free cash flow based valuation? Whenever dividend is not the right basis of valuation, you may use free cash flow based valuation, but the condition would be the free cash flow itself should be positive, or else let's say you are talking about a majority stakeholders perspective. Since I've already talked about these points, I'll not get into details of it very quickly. As I said, I'm going to be fast over here. Residual income, when should you use it? When both the free cash flow as well as dividend based valuation models cannot be applied. Which are the conditions they are not applicable? When they are negative, or let's say there is no dividend history, or some other reason the company is in a growing phase, for some reason they cannot be applied, then as a compromise situation you may apply a residual income model. Although this is a high level talk that I'm gonna do, all these models should theoretically generate the same value for a company, all these models, but you're gonna study about that in the future. I'll not talk about it right now in details, but I've given you food for thought. Okay, we move on from here, and now let's talk about the discounted cash flow valuation. So what is the process of applying discounted cash flow based valuation? Okay, the process it comprises 3 very simple steps. You know the definition of discounted cash flow based valuation. It says present value of all future cash flows is the value of a security. Okay, so I'll repeat. Value of any security is nothing but the present value of all future cash flows. If you apply that definition and you convert it into steps, firstly, you need the future cash flows. The first step should be forecast future cash flows. Well, how do you do that? To do this, you need growth rates, growth in the cash flow. So let's say we are talking about dividends. So you need dividend growth rate, which is denoted with this term called G. You need the dividend growth rate to do that. So let me take an example. Let's say you already know what is D naught. That means D naught represents the dividends in present. How do you calculate the future cash flow, the future dividend? Simply multiply it by 1 plus G raised to power N, or and represents a number of periods. Okay, you could use T. In certain books they use T over here, so it's all flexible. You may use any term as long as the meaning is not lost. Okay, let's talk about the second step. Okay, once you got the future cash flows, you need to discount the future cash flows back to present. Discount, I'm going to use a short form, future cash flow. It's not free cash flow, it's future cash flow to present. So you need to bring them back to present. How do you do that? I'm sure you've done that in quantitative techniques level 1 many a times. The discounting is done like this. So let's say this is your future cash flow, D naught into 1 plus G raised to power N. How do you discount it back to present? Divided by 1 plus R raised to power N. Okay, N again stands for number of periods. Okay, so this is how you discount it. Well, there's a very important point which I want to point out over here. What is this R? This R is basically required rate of return. It's the required rate of return. Okay, this R represents the risk involved in the future cash flow streams. Okay, so this is point which is noteworthy. I need you to note it down, that the R over here represents the risk involved in the future cash flows. Okay, so let's move on from here. And you have already done in first and the second chapter and also in the past that how do you calculate required rate of return. You have studied through models like Pharma French, CAPM, CAPM we call it. You got so many other models out there. They're all there to calculate the required rate of return. Okay, so you may do that. Well, now that you discounted all the future cash flows back to present, all you need to do is to add up all these present values. So once I do that, the value of a security now can be expressed as summation of present value of all future cash flow. This is a future cash flow, 1 plus G raised to power, let's say n, divided by 1 plus R raised to power n. Okay, so this is how you may value a security using discounted cash flow process applying dividend discount model. So we got the dividend over here as well. Okay, so just a conclusion on the DCF very quickly. There were 3 steps. You had important terms like G and R involved. You discounted all of them back to present and you added them together. That's how you got value of a security. Okay, we take it further. Let me give you an example now. Let's say we are talking about a security which is projected to give a dividend next year of, let's say, $5, and the year next to that of a dividend of $5.5, and in the same year, in the same second year, let's say this security would be sold at an estimated price of $60. Okay, let's say the required rate of return from this company, because it's a risky company, is, let's say, 14%. Okay, well, how do you calculate the value of the security in this case? The process would be very simple. Value of the security in this case would be $5, which is the dividend for the next year, divided by 1.14. But this is 1 plus R, so it's 1.14 raised to power 1. Why 1? Because it's the first year's cash flow. Plus, now this is 5.5, but in the same year you got 60 as well. So let me take the total second year cash flow being $65.5 divided by 1.14 raised to power 2. Okay, so once you solve this question, you will get the value of the security. I'm not going to do the calculation due to paucity of time, but I'm surely going to guide you that this is how you do it. So this is how you calculate the value of a security. Well, there's a major flaw in this calculation process. I don't know if you notice that, or this question kind of clicked in your mind. See, if this investor could forecast that $60 would be the price at which the person can sell it in the second year, then the person should be good enough to forecast the present, the value of the security at present. If you're that good, then you can do that for the present as well. But that's nobody's cup of tea to do that. We all have to estimate it. So the way I look at it, do not assume a finite period. Assume an infinite time horizon, so that you never have to estimate the selling price for the future. Okay. So when you assume an infinite price, and I'm gonna start this conversation with a very special model known as Gordon growth model. We also call it constant growth model. Let me write it on the top. It's part of discounted cash flow valuation only. The Gordon growth model. Okay. So what is Gordon growth model, or we also call it constant growth model? What is that? In this model, you believe the G would be constant. That means the growth rate of the company would not change. And normally it happens for mature companies that they continue to, you may safely assume that these companies will grow at a constant rate on an average throughout the future. Okay. So in such companies, the formula for valuation of a security can be expressed like that. Okay. So this can also be rewritten as D1 divided by R minus G. Okay, so this is how the formula changes. Why this formula has changed? Because growth has gone constant, and using sum of a geometrical progression, a concept which is not covered in your curriculum, you may filter down the formula to a simplest state. But do not worry about the derivation of this formula. That is not important. Or what is important is the formula itself. So as per constant growth model, this is how you may value a particular security. Well, we may talk about this model at length, but just because we have very little time, I would like to call off the session over here. Well, if there is any question, feel free to send me an email at arun.babbar@gmail.com. On that note, thank you so much for giving your time. Wish you all the best.